Hey traders, welcome back to the Gain Trade channel. My name is Mike Sir. In this video, I'm going to share with you how you can protect yourself when there is a stock market crash or when the markets are extremely volatile due to unforeseen events. It's a trading strategy called hedging. Now make sure you watch the entire video as I will share with you many ways to protect yourself. But before we dive in, don't forget to hit that subscribe button and ring the notification bell so you'll never miss a video from us. Now let's get started. First of all, let's talk about what hedging is. Now, hedging is a risk management strategy that involves taking a position in one asset to offset potential losses in another. Now, the primary goal of hedging is to protect an existing position from adverse price movements. It's essentially an insurance policy for traders if the trade position doesn't work in their favor. Besides helping you to mitigate risk, there are several reasons why traders choose to hedge their positions. One reason is some traders just don't want to use stop loss orders on their existing trade positions in case they get kicked out and then the price goes in their favor. Hedging allows them to still hold their current positions without experiencing further losses. And I'll share with you later what trading instruments you can use for hedging. Another reason is traders shouldn't have their positions concentrated in a single asset or sector, and therefore hedging allows for portfolio diversification by adding uncorrelated assets to a portfolio, thus reducing overall risk exposure. Now, for example, if you have a technology-heavy stock portfolio, you may want to consider diversifying in, let's just say, the healthcare sector that has no correlation with technology. Also, hedging can be used to lock in gains while still participating in the potential upside movements. Now, for example, instead of exiting a position, you can put on a hedge that allows you to take some profits. Now, let me share with you the different types of financial instruments that you can use to hedge. One popular way is to use option contracts to protect against adverse price movements of the company stocks that you are holding or just the overall stock market volatility. This can involve buying put options to hedge against price declines, and put options are contracts that rise in value if the underlying asset goes down in price. Or you can buy call options contracts to hedge against price increases if you are shorting the underlying asset and the price goes up. Another way is through futures contracts, which allows traders to hedge by locking in a future price for an asset, which can help protect them against price volatility. Now, this is generally used to hedge against the overall stock market as there are no futures contracts for individual stocks. Now, for example, you would sell futures contracts on the S&P 500 if you felt that the overall US stock market would fall. Another way is through using exchange traded funds, or referred to as ETFs. Now, they can be used to hedge specific sectors or asset classes within a portfolio. For example, if you own a tech stock like, let's just say, Apple, you can protect yourself by shorting the tech sector through a technology ETF such as XLK. For currency traders, they would use Forex hedging strategies to protect against exchange rate fluctuations. Now, for example, if you hold a lot of assets denominated in euros, but the euro is falling and your main assets are in US dollars, then you would sell euros and buy USD. Now that you have a better understanding of hedging, let me share with you 3 hedging strategies that you can use to limit your risk. One is called long and short hedging, where you take opposite positions in related assets, such as buying an oil stock while simultaneously selling a related oil futures contract. Now, this helps protect you when your oil stock falls due to lower oil prices, as you would profit from your short oil futures position. Another way is portfolio hedging, where you hedge an entire portfolio to protect against systematic market risk. Now, for example, if you hold a portfolio full of US stocks, you can protect yourself by selling S&P 500 futures contracts, which will go up in value if the US stock market declines. Lastly, the way we like to hedge is through pair trading. Now, this is where we simultaneously go long one asset and short another correlated asset to profit from relative price movements. For example, let's say that I believe gold prices are going to go up, and the best way to profit from this is to buy gold stocks. Now, I identify Newmont Corp has the best gold stock to buy, but I want to protect myself in case gold prices go down. So what I want to do as a pair trade is to buy Newmont stock, symbol NEM, and short sell GLD, which is the gold ETF that tracks gold prices. This way, if gold prices go down, then my gold ETF, GLD, will be able to limit my losses on NEM stock. Now here you can see that the bot builder in GainTrade identified two trading opportunities in the Newmont versus GLD trading pair over a 3-month trading period, as referenced by the green arrows. And this is where the AI bot executes these two pair trades and recognizes a profit on both of them. Even though hedging has its benefits of limiting your risk, there are some risks and challenges of hedging. The most obvious one is it limits your upside. So if you put on a hedge on a stock that is going in your favor, then you limit the amount of profits that you would gain. Therefore, it's all about trying to determine the right scenario to hedge as well as how much to hedge. Now, balancing these hedge positions can be challenging. Over-hedging can result in eliminating all upside, while under-hedging may not provide adequate protection. Also, hedging is not always perfect, and there is a risk that the hedge may not offset the losses in your portfolio. For example, if you hedge your existing stock positions by shorting the US stock market index like the S&P 500, but if the index does not go down, then you will lose money on both your positions. As well, keep in mind that hedging does not eliminate all potential losses in your individual stock positions. It will help offset some of the losses that you would incur, so therefore there is no perfect hedge. Thanks for watching. If you found this video helpful, please give it a thumbs up and hit the subscribe button below for more trading tips and strategies. Also, don't forget to leave your questions and comments below. We love hearing from you. I'll see you all in the next video.